I think we all want to go to the moon, but if you want to ride the rocket, you got to be prepared to pull the G's. Over 5 years, Bitcoin's had like 6 brutal drawdowns. If you roll the clock back 13 months, we were sitting around 68,000. And then after the Trump election, we had this incredible rally from 68 to 106,000 in 5 weeks.
When Bitcoin suddenly lurches lower, headlines scream about disaster and collapse. Michael Saylor starts somewhere very different. For him, the so-called crash is just another surge of G-forces on a rocket that has already taken investors from 55,000 to 6 figures and back again. Instead of treating volatility as a bug in the system, he frames it as the admission price to a network that has already cycled through repeated drawdowns and recoveries. That context is where his entire argument about the current crash begins.
If you go back 14 months, we were about 55,000. And so if you'd said we're going to go from 55,000 to 94,000 in 14 months, that would have exceeded any reasonable investor's expectations. Over 5 years, Bitcoin's up about 50% a year on average for the 5 years. Gold and S&P are studying the cost capital at 14%. My company's strategy is up 71%, equivalent to NVIDIA. There's no other stock in the S&P that's done any better.
Here, Saylor zooms out beyond the red candles on the chart. The drawdown that feels catastrophic in the moment still sits on top of a move that most investors would have considered wildly optimistic a year earlier. Against that backdrop, the crash looks less like a failure and more like a violent repricing inside a long-term compounding story. He also points to MicroStrategy itself, tying his personal credibility to the asset by comparing its performance to a market darling like NVIDIA rather than to struggling value stocks.
So I think the volatility comes with the territory. If you're going to be a Bitcoin investor, you need a 4-year time horizon, and you need to be prepared to handle the volatility in this market.
So when you look at the price right now, and then we'll talk about the implications for strategy, but when you look at the price right now, what does the upside at this moment look like to you, and what does the downside in this moment look like to you?
I feel like we put in a pretty strong base of support around here. There's an incredible amount of leverage coming out of the system, a lot of liquidation.
In other words, Saylor thinks you cannot judge Bitcoin through the lens of a trader staring at a 12-week window. He frames the crash as a leverage flush, not a fatal wound. The pain belongs to those who loaded up with borrowed money and got forced out. Long-term holders, in his view, are standing on a new floor that survived a major de-risking of the market. That is why he puts so much weight on a 4-year time horizon as the minimum commitment.
A lot of the OG holders were selling at the $100,000 level, and so I'm fairly comfortable at this level. I would think that we'll build from this base and we'll rally from here. Obviously, it's hard to make a forecast for the end of the year right now, given what's happened over the past few weeks, and especially the shift in the macro environment. But, as you know, my view is Bitcoin's going to outperform gold. It's going to outperform the S&P. It is digital capital. And so if you're a long-term investor, this is the place to be.
Saylor does not pretend the crash is trivial or that the macro backdrop is friendly. He admits forecasting the next few months is nearly impossible, but he still insists that the structural story has not changed. In his telling, early adopters who took profits near the highs simply handed their coins to new holders at lower levels. For anyone with a long horizon, he believes the question is not whether the crash hurts, but whether Bitcoin will still outperform traditional stores of value once the dust settles.
Well, I mean, it's pretty important to note that we're not even 1.15 times levered. We're very fractionally levered, and our debt that we have is 4.5 years out. So we don't really have any trigger points anytime soon. And if Bitcoin were to fall 80%, we're still over collateralized and we're fine. So our balance sheet's pretty stable. The company's strategy, just like an intelligent bank, would be to build amplification for the common stock using preferred equity. So the equity never comes due. It's a dividend payment declared by the board. It's not a coupon. We can't be in a default. There is no credit default situation from the digital credit that we're selling at this point.
That structure is his answer to critics who say the crash could wipe out his company. He wants investors to see MicroStrategy as a kind of specialized bank, using long-dated, flexible capital rather than dangerous margin loans. By designing things so that even an 80% drawdown does not trigger a crisis, Saylor argues that volatility is survivable. From his perspective, the real risk lies with entities that borrowed short-term against long-term assets, not with a company that has locked in its funding for years.
Right now, the way to think of it is that half of the economy is built around Bitcoin. It's digital capital. Bitcoin is digital gold. And the killer application on top of digital capital is digital credit. Instruments like Stretch, STRC, credit instruments that pay yield. And that's a very simple business. The other half of the economy is digital finance. And it's going to be built on the proof-of-stake networks that are emerging, the Ethereum Solanas, the BNBs. And the killer application for that part of the digital assets economy is tokenized currencies, a la stablecoins.
Even in the middle of the crash conversation, Saylor zooms back out to the broader digital assets map. He divides the space into two worlds: digital capital centered on Bitcoin and digital finance built on proof-of-stake platforms. In this framing, a violent correction in Bitcoin does not invalidate the idea that it sits at the base of a growing credit system. Instead, he portrays it as the volatile anchor asset on top of which more stable instruments can be built.
Tokenized securities, tokenized real-world assets, tokenized brands, and DeFi in general. Well, that's a very complicated technical development, and I'm sure that stablecoins are going to go from hundreds of billions to trillions of dollars, but it's not really competing with digital capital. No rich person wants to buy the currency instead of an equity or a real estate or a capital asset.
Here, he addresses a common fear, that the rise of stablecoins and tokenization might make Bitcoin obsolete. His answer is that these tools live in a different lane. For him, Bitcoin is the savings asset, while stablecoins are the transactional rails. A crash in Bitcoin's price may shift short-term flows into perceived safety, but in his view, it does not change the fundamental role he thinks Bitcoin will play as a long-term store of value for large pools of wealth.
Michael, given where Bitcoin's trading right now, are you buying?
We are buying. We're buying quite a lot, actually, and we'll actually report our next buys on Monday morning. I think people will be pleasantly surprised. In fact, we've been accelerating our purchases.
Are you ever not buying, Michael?
No, we're always buying. Bitcoin's always a good investment.
If you want to know how seriously someone takes their own thesis during a crash, you watch what they do with their money. Saylor insists that MicroStrategy is not stepping back but leaning in, accelerating purchases even as prices fall. Whether viewers see that as conviction or stubbornness, it is consistent with everything else he says. If volatility is the price of admission and the long-term story is intact, then a crash is not a time to run, but a time to add.
We now own nearly 3.1% of the network, and we bought it on a blended average about $74,000 a coin. The point that I would make for any investor is, if you have money you don't need for 4 years or longer, and if you don't trust anybody, you want no counterparties, you just want to own a piece of the global digital economy, you buy Bitcoin. It's the commodity. If you're an equity investor and you want to bet on digital credit and you want to bet on digital capital and you want some amplification, you buy an equity like MSTR.
Here he lays out a simple crash playbook. Long horizon, high trust in the thesis, and a desire to avoid counterparties push you toward holding the asset itself. Willingness to accept more risk for more upside points you toward his company. He is not talking about day trading the drop, but about aligning your exposure with how much time and volatility you can stomach. The crash becomes a filter that separates tourists from the kind of holders he is speaking to. In the end, Saylor frames the downturn as a stress test of structure, conviction, and time horizon. He argues that MicroStrategy is built to withstand even deeper declines, that Bitcoin still sits at the core of an emerging digital capital system, and that stablecoins and tokenized assets will expand the ecosystem rather than replace it. For him, the crash is painful, but it is also the moment when those who understand the asset decide whether they are holders, builders, or sellers.
If you have money for less than 4 years and you're an investor and your time frame is 12 weeks, you should buy the digital credit. For example, the credit instruments we've created have stripped the volatility off of Bitcoin. Bitcoin's vol is like 45 on a trailing 30-day average. We have instruments at 28, 21, 15, and stretches a vol of 8. So if what you want is like a serious yield, you want the credit. You don't want the equity or the commodity.
Hearing his full case, how do you see this latest Bitcoin crash? As a warning that the story is breaking down, or as the kind of volatility that creates opportunity depending on which part of the digital asset stack you choose to hold?